our advice is that's what we sort of live by. So we said, we absolutely can't help you. So they went away, found a provider that would help them. And then within 9 months had an inquiry from HMRC, and now they've got a £2 million tax bill.
But I was approached a few weeks ago by someone a landlord on a residential mortgage who'd rented out their property, and the lender had found out. Whether they'd done that through council tax records, whether they'd done it through TV licensing records, or whether they'd done it through some other means, I don't know. But I know they run numbers and checks. You may never get caught. You may get caught on day one. And if you get caught, there's a problem.
Why some people wouldn't speak to the correct person for the correct advice and listen to a forum or a guy down the pub that says that he's done it before.
Okay, so welcome along to another show on the Investors Corner. Again today, we've got a fantastic guest. Andy and myself are hosting, and it's Amanda Perrotton of BellHowleyPerrotton, a legal firm specialising in landlord tax affairs, incorporations, joint ventures, and other specialisms. So, Amanda, firstly, thanks for joining us.
You're welcome.
First time podcast?
First time podcast with you, but we run our own podcast.
Fabulous.
Well,
so we can plug that.
Idea.
It's a good start. You'll find Amanda's podcast on our show notes. If you listen to this and you are interested to hear more from them, is to get onto Amanda's podcast if there's more information you ever want. So first, with 30 seconds in, one plug down. How are we getting on? Andy, let's chat. What are we going to talk about today?
So we are going to talk about today is incorporation. So one of the things that we look at when you're sort of a landlord or an investor is how you can incorporate your property portfolio, how to make it more tax efficient, how you can build wealth, and sort of the joint venture side of stuff as well. So I'm really keen to get your thoughts on your experience dealing with that. Are there any sort of top wins that we can give to our investors and landlords on how to do things on their end? So yeah, a lot to discuss, a lot of interesting stuff that I'm sure that's going to come out of this podcast. So so straight into
incorporations.
Incorporations.
Wow, okay.
Let's go deep.
Let's go.
Okay, so if you're looking at somebody that's got property in their personal names, one of the downsides is that those properties form part of their estate for their inheritance, and also they'll pay tax at their personal income tax rates. So, and obviously the big one for landlords is the Section 24, so they can't offset their mortgage interest payments. So lots of clients look to incorporate their property portfolio to alleviate the Section 24 problem, so they can then start to offset mortgage interest payments as through their profits. And then once you put those properties into a limited company, you can start to do some fairly basic wealth planning. You may have heard of family investment companies. Out in the market, you'll hear things referred to as freezer shares or growth shares or alphabet shares. And the idea is that you look to the short, medium, long term in order to gradually distribute your wealth over the period of your working life, so that once you get to 55, you then are taking the income from your business or the business, rather than having a large capital sum attributed to your share capital, because when you die, that's what will then be valued for inheritance tax purposes. So there are numerous and many ways in which you can do that. The legislation for incorporations has been around for about 50 years, so it's nothing new. But obviously the advent of changing the mortgage interest payments brought it into sharp focus for people, because I think you'll find that many of your listeners potentially are already making losses on their portfolios on a monthly, if not annual basis. And with the mortgage interest rates as they are at the moment, I think it is starting to really cripple people. Actually, I saw a stat this morning.
We love a stat.
Yeah. There we go. Let me read this out. So CGT. So record amounts of capital gains tax were declared, So the total amount of CGT liability was 16.7 billion, 15% higher than the previous year. And a lot of that is down to the fact that landlords are actually selling their portfolios, which you must find.
Yeah, absolutely. I think we haven't got the stat, but it feels like 100% of tenants are registering at the moment. And when you say, why are you moving? Because my landlord served me notice because they want to sell the property. And I want to question every single landlord whether they're making the right decision or whether they're just jumping on a bandwagon, because a lot of landlords are selling because of the upcoming changes or so-called changes to Section 21, the eviction notice rule and the rights for tenants, which we dispelled quite a few of those with Liam on our pod a couple of weeks ago. So we don't think there's too much to fear from that. But as you quite rightly say, there's a lot of landlords who are now going from nice, healthy profits on a monthly basis to losses. And I would throw another sort of guess at the wind that a lot of landlords have a reasonably high PAYE salary. And if you've got 2 buy-to-lets and they're taking that rent gross as your income, massive percentage of landlords must be hitting that £100,000 to £120,000 income black hole where you're effectively paying double tax and losing your tax-free allowance, which is where the problem comes. You're paying the thick end of 60% tax at that kind of income level. So for your stereotypical landlord who might earn 85k a year through work, have 20 to 30,000 pounds worth of income from buy-to-lets, 2 buy-to-lets that they've bought over the last few years, at what point can they consider engaging someone to do something about their problem without having to go, oh, do you know what, sod it, I'll just sell it?
Okay. So I think that with the advent of the changes in Section 24, I think it opened up the market for people to come in and look for loopholes to enable people to fit into a criteria that, as I say, was legislated on 50 years ago. So I think as a result of that, what you've created is almost an industry around incorporations instead of whether or not the clients are actually meeting the criteria. And the criteria for incorporating a property portfolio, for example, is governed by one case, and that's Ramsey, which everybody's very familiar with. But I think that what people aren't so familiar with is the way in which that case operated and how it will operate for you. So one of the fundamental things that came out of that case is that as a landlord, you need to be actively involved in your portfolio for around 25 hours a week. So if you are working full time, that doesn't preclude you from meeting the criteria, but you have to think about how you are meeting that criteria. So if you are entirely passive and everything is outsourced, then the chances are, you're not actively involved in your business. You're outsourcing it. You're just passively receiving the income. But in those circumstances, it's unlikely that you're going to fall at the first hurdle. So what are you doing within your business? Is it being run as a business? So in terms of the key element about the Ramsey case and incorporating it successfully is that you roll over the capital gain into the company. So you take the original base cost and it's effectively uplifted at the date that you incorporate, which is a huge advantage to people. You know, one of the things that landlords are having difficulty with is that if you have started, you started your portfolio in 2005, 2010, 2005, you'll have bought perhaps a little bit high, hit the recession in 2008, it's dropped. It's then, sprung back up again. There's a lot of latent gain in those properties. And if you sell and if you trigger that capital gains tax, the requirements are that that gain has to be paid, or the tax has to be paid within 60 days. So for landlords, you can't defer it, you can't pay it in installments. It has to be paid. You have to submit the return. So that's quite a big ask. So actually meeting the criteria for Ramsey is essential before you do anything. So if you work full time, and let's say your full time is 9 to 5:30 Monday to Friday, it doesn't mean that you can't fit that 20 to 25 hours within that working week as well. So if you're spending a lot of time at weekends, if you're constantly emailing, if you're looking for other properties, if you're undertaking some of the maintenance yourself, you could very easily demonstrate that you are contributing that amount of time each week. But it needs to be recorded, because what you need to allow for is what happens if HMRC ask you some questions about it. You have to be ready and able to justify why it is that you are going to qualify for the incorporation relief. Because as I said from those stats just now, this is a big winner for HMRC, and they're not going to want you to just.
They're not going to allow people just to hop from one fad to the next, are they?
Correct. So, so I think that's one element, is that you need to make sure that you are contributing that amount of time. And if you're in a partnership, which I can talk about as well, but you both need to be actively involved. The more passive you are, the less likely you're ever to gain any kind of relief. So if you can obtain incorporation relief, you will save yourself a significant amount of money. If you also need to think about the fact that if you transfer properties from your personal names into a company, for all intents and purposes, it's a market value sale. So there'll be SDLT payable on it. So stamp duty, land tax comes into play. You will get something like multi-dwelling relief because of the portfolios moving all at the same time. But ideally, you want to not have to pay the stamp duty as well. The way that you can do that is use the partnership rules. Put your portfolio into a reasonably standard general partnership, and then that will, through a calculation, invariably qualify down to nil, so that you can then not have to pay stamp duty, land tax, and you can roll over the gain. So you need to be able to get decent advice that enables you to move from one to the other. But I think one of the biggest problems, aside from those points, is your lending. So what are the current mortgages, fixed terms, fixed rates? So you're then going to start looking at refinancing a portfolio. And for some landlords that are cash poor, that could also present something of a problem for them.
And many are. We're sat in the southeast, as everybody knows, where asset value's high, but it doesn't necessarily mean that that individual is, in inverted commas, rich.
Yep.
I don't know the best word for it. With just cash rolling around, they may have had these properties for a number of years and they've gained value. Doesn't mean that there's cash sitting around in a pot to do that side of things. So that's the other side. I mean, we obviously talk about, I think it's probably every other week we have a mortgage broker on, and we absolutely hound them for what's going on, as we have done for the last 10 months or so.
I mean, we've got a client going through an incorporation at the moment who is desperate to get it across the line, and he's flipped onto the standard variable and he's currently paying 9.25%.
Wow.
So he is hurting.
Yes.
And it's a very, very painful position to be in. So it is causing quite a lot of hardship. But I think, if I can call it a myth, is that you can't, when you incorporate a property portfolio, you need to move the whole lot at the same time. It needs to transfer from the individual's personal names into the company name. And if that happens, then the mortgages need to change.
Yeah.
So the portfolio needs to be refinanced, whether that's with a lender like Paragon, who provide incorporation mortgages, and they will allow it to transfer. Or if you just have to refinance the whole lot at the point that you actually transfer the properties. But a misconception is that, don't avoid the mortgage question at your peril, because if
you're immediately in breach of the terms of the lending, aren't you, as soon as you do it, if you if you decide to
Immediately.
be a bit blasé about
Yeah.
it from day one, you're in
Yeah.
breach of your mortgage.
I mean, and I think that sort of several prospective clients we've chatted to said, well, how actually is your lender going to know? But obviously, as professional regulated people, that's not something I'm going to answer.
They have their ways and means, and how often they're checked, I guess, depends on the lender, doesn't it? But
Well,
I was
yeah.
approached a few weeks ago by someone a landlord on a residential mortgage, who'd rented out their property, and the lender had found out. Whether they'd done that through council tax records, whether they'd done it through TV licensing records, or whether they'd done it through some other means, I don't know. But I know they run numbers and checks of percentages of their portfolios for their due diligence. You may never get caught. You may get caught on day one. And if you get caught, there's a problem.
Yeah.
Yeah.
Well, I mean, a client of ours, as we were going through the incorporation, the properties had to be obviously had to be. They were. I think some of them were staying with one of the lenders, and so they were revalued. And when the surveyor went round to do the valuation, they noted that rather than it being a 3-bed house with 1 bathroom, it was a 3-bed house with 3 bathrooms. So they'd made the alterations. I think they'd probably transferred it into an HMO or something like that. And they'd made the alterations without the lender's consent. So the lender said, well, actually, when you financed with us 3 years ago, there was only 1 bathroom and now there's 2 bathrooms. You've done that without our consent. So we're going to red flag the account. So they red flagged it for a period whilst they waited. It wasn't that they stopped it or called in the debt, but it certainly meant that the incorporation was delayed by a further 2 months, which, if you're paying significant
If you're
amounts,
sat on that standard variable rate, it's a painful wait, isn't it?
So I think that, and especially with, media attention, HMRC, all their systems link up. I mean, we do a lot of stamp duty land tax advice for clients, things like MDR or uninhabitable properties. And one client had, as you mentioned just now about the council tax, well, if you've claimed multi-dwelling relief, and you're saying there's 2 separate dwellings here, then obviously the local authority are perfectly within their rights to charge you council tax. And if you say, well, I've turned it back, well, then they'll invoke the 3-year rule, and that means that they'll say, well, okay, we'll claw back the relief you claimed. So they are very much alive to people claiming reliefs. I think there's something like 1,200 reliefs available, tax reliefs are available.
Go on, Andy, name them.
Yeah.
No, not in this podcast. That'll be on a separate podcast released next week.
but they're supposed to be simplifying it.
Yeah.
That's the whole point is tax is supposed to be getting easier. But
it's the same. It's like lettings regulations, isn't it? You can see, there's hundreds and hundreds of regulations, which is why we say to a landlord, use an estate agent to cover your back, because everything we do is fully signed off and regulated under the fact that we're ALA members. Same goes for taxes. I mean, how on earth is an individual supposed to know when they're filling out one of their forms what they're due?
I think that, and a lot of these are self-assessed taxes. So I think that is a huge point, is that you don't know what you don't know.
No.
And even with the best of intentions, obviously the HMRC has an opportunity to levy penalties against you. So failure to pay, they'll automatically charge you interest, and then they can decide what type of penalty they're going to levy against you for failure to pay the tax on time once they've assessed you to tax. That could be up to 100% if they believe that you've been, egregious, if you've really deliberately decided to seek a way to avoid a tax. And, coming back to incorporations again, for clients looking at that as an option, it's really important for you to be looked at personally. So how it affects you holistically, but not measured against anybody else. So any of your other landlord mates on the various forums you all listen to. We had a prospective client on this morning, and rightly he was saying, I'm just so confused about what's right and what's wrong. You go on to all the different forums, and everybody says something slightly differently. I think if you treat people as individuals and you advise them on their personal circumstances and you seek advice on your personal circumstances, It's much better way to go than thinking that you can fit into a one-size-fits-all, because tax advice just isn't like that, and HMRC definitely are not like that.
No, I mean, landlord forums, I think there's a place for them, because what you don't want to feel is lonely, and it can be a good place to take your recommendations and make a start with something to get you into a wormhole somewhere. But the flip side of that is landlord forums are like today's Dave down the pub.
Yeah.
Is I've done this, so you should do it too kind of mentality, which leads a lot of people to do something. And as you say, no two people's circumstances are the same. So you need to have some sort of independent advice that can provide you with a bit of a guarantee against what you're doing, rather than user 1642 who said it was a good idea.
I think that's absolutely right. I mean, we did have in exactly that, Dave down the pub situation. We had a guy that came to us for some advice, and he had been told by Dave down the pub that actually he could spread the income out. So you were saying right at the beginning of your introduction about, somebody's getting up into the sort of over 100,000 bracket. So they'd suggested that they spread the income from the portfolio between their wife and 2 sons. So all the properties have been held in father's name, and he had amassed, I don't know, let's say 20, 25, I can't remember that, but there was quite a large number of properties that they'd got. So what he decided to do was divert the income. So 25% to each of his sons, 25% to his wife. So that brought everybody's, well, the son's income tax obviously had come up, but I think they were sort of 19, 20 at the time, and his had come down. And during the discussion, we said, well, what have you done about the fact that you will have triggered capital gains tax on that? And he was like, well, I don't know what you're talking about. So I was like, well, you've gifted 25% to your son and 25% to your other son. So at least 50% of your portfolio has been gifted to those 2 people. Obviously, there's dry tax charges between spouses, but you've triggered a capital gain on gifting, because otherwise they're not entitled to the income. So you would have at that point had to have paid the capital gains tax, even though it's a gift. I think people naturally think that there's no money changed hands, but it's obviously a market value transaction.
Yes. Yeah, you can't just call it zero value.
Yeah. So from 2016. We didn't hear from him again, but but I think that that's kind of an example of the fact that people, I refer to it as a ripple effect. So if you're going to drop a stone in, just be wary of the ripples that are caused.
Yeah. When you come to sell that property, your solicitor is going to mark that as a property that's due capital gains. Questions are going to get asked, and little red flags are going to pop up all over the HMRC of, well, where was the income for the last 15 years?
And they'll be able to track that, because the sons have obviously been paying income tax on the income that they've been receiving from, so they will actually be able to track it back to 2016. Now, again, are they going to pick it up? Who knows? But I just think, just be wary of the ripple effect.
It's going to leave you sleeping a little bit light at night, right?
Yeah. It would, wouldn't it?
Sick.
That's why I just don't get, like, for big investments like property, or if you've got multiple properties, why some people, obviously the majority of people would, but why some people wouldn't speak to the correct person for the correct advice and listen to a forum or a guy down the pub that says that he's done it before.
But don't you think that's just come down to paying fees?
100%.
Yeah.
I mean,
yes.
I do think that's, people don't want
I can do this for you. It will cost you this month. Stuff that. I'll go on Google.
Yeah, but in the long run, it could cost you
tens and tens of thousands of pounds that you don't have.
Absolutely.
Yeah,
absolutely. I mean, I think that for me as a solicitor, it took me 6 years to qualify. If I could have got the answers out of Google, I would have done.
Have his ChatGPT caught up on you yet?
Yeah. Well, I think it will.
You've just got to know what to type in at the moment to get the right answer. That's the question, isn't it? Is whether you've asked the question in the correct way.
Yes.
to get the correct answer, and you don't know whether you're going to get the correct answer unless you're qualified at the
Exactly.
moment.
And I just think, like, even with ChatGPT or whoever, it's the ripple effect. I mean, Dave down the pub may have the right answer in relation to income tax, but he hasn't thought about capital gains tax because he's not a chartered tax advisor, or whatever profession or, qualification you are. And I think but I think it's just fees. Somebody doesn't, and you say to them, it's going to cost you £5,000. And they're like, I mean, I've got too many horror stories. But there's another client, they came to us for an incorporation, both of whom were doctors. So coming back to the Ramsey test, are you spending 20, 25 hours a week? They came to us and asked our advice, and we said, this isn't going to work for you because you're just not going to qualify. And obviously, as regulated professionals, our advice is that's what we sort of live by. So we said, we absolutely can't help you. So they went away, found a provider that would help them, and then within 9 months had an inquiry from HMRC, and now they've got a £2 million tax bill for their CGT, because they didn't
suddenly gone white.
They didn't want to pay, I don't know, £8,000. I can't remember what the fees were charged at the time, but it was, or quoted at the time. But and obviously, again, that's quite an extreme example, and perhaps people think, well, God, that's, I don't have £2 million worth of gain. But even if you had £100,000 worth of gain in your portfolio, you're not prepared to pay 10% of that. You'd rather actually pay the £100,000 if you were to get caught.
So we've heard the horror stories and the reasons why people would do it. At what point, in your opinion, of building a portfolio or owning a portfolio, is it actually worthwhile incorporating over holding things holding property in a personal name?
Okay, so I think that if you are listening and you are at the very, very beginning, then as things currently stand, you would be as well to purchase that property in a limited company. Now, some people are put off by that because of the commercial rates for lending. So again, it's something that you need to weigh up in terms of the offset that you will achieve on your mortgage interest payments as against the additional interest payments that you will make as a result of it being a commercial mortgage. At the moment, I would say that, with somebody with a very small portfolio, it's definitely a balancing act. And it's something that you need to sit down and review and think about. And also what your short, medium, long-term plan is. So, as I said right from the beginning, if you have a limited company and you have shares, you can have a family investment company, which is just a straightforward limited company anyway. You can move those shares around. So it doesn't matter how many properties or investments, or you could do a joint venture with somebody else that involves management of properties. You could have a development arm, you can have a management arm, you can have a freehold arm. But ultimately, you've only ever got one set of shares that you are managing and that you are wealth planning with. So right from the very beginning, you can put in place a very simple structure that will make things easier for you going forwards. If you're somebody that has a very small portfolio, you're right at the beginning. If you think I've got 2 or 3 properties and actually, is it going to be worth my while? The amount of time that you spend, your plans for the future, those variables could make you think, I think I'm going to sit where I am. It may be that if you decide subsequently to buy future properties, you'd set up a company and start putting them into there so that you've got something, you're sort of across 2 stools, as it were. If you have got, a property portfolio of sort of 5, 6 properties upwards, then I think it is worth you thinking about what you're going to do with them and how much it's costing you, how much time you spend on the portfolio, and how much gain there is in it. So I think that now obviously is a good time to be thinking about it with the increases in the rate rises. Inheritance tax is a big consideration for everybody. Things are tight, life is tight for people, and so their income is important, because obviously whilst it's in your personal name, every penny that comes into you as a sole trader or a partnership is taxed as personal income. If it's in a company, you're only going to pay tax on the money that you actually draw out. So obviously if you draw dividends or if you draw an income, so you're able to manage your income much more easily within a company. So I'm not sure if that's a woolly answer, and I haven't really probably said.
But I think the people who are listening are going to resonate with certain points of that. And I agree. If you're just buying one property or two properties, it's negligible whether you'll ever see a benefit, unless this comes back to your why. And it always comes back to why are you doing this? Why are you buying a property? Why are you renting a property out? You're looking at specifically, I'm buying this property so I can hand it to my son. Now, incorporated, they could potentially become a shareholder of the business and you can transfer shares. You're not transferring the ownership of the property. So from where I'm sitting, you're not paying stamp duty, you're not paying these taxes because the property isn't changing hands. It still belongs to the company. You're transferring shares in the business.
One thing I would say about the shares that you're transferring in the business, it's good to think about that before you incorporate, because obviously once you incorporate, if it's a relatively new company, there's no value in the shares. So gifting shares is the same as gifting property. They're going to attract a capital gain. So you need to allocate and sort out the share structure before you start to load up the company with gaining assets effectively. But it's certainly the case that you can update the articles of association, you can make them bespoke for your family so that shares are kept within the family unit. You can allow for things, divorce, bankruptcy. If your son or daughter, I don't know, has a gambling habit and you're sort of anxious about the way that they're going to own those shares, though that can be allowed for if you want to make charitable gifts, if you want to. We've had clients where shares have been allocated to their church or to some other community project that they've been involved in. So it's very, very flexible and it's very malleable to, again, sit in with however a client wants to, manage the rest of their life, really. But I think in terms of income, one of the key problems with holding it in a partnership or personally is that you will, irrespective of what's happening to that income, you will pay income tax on it.
Yeah.
Whereas that's what you can start to manage when it goes into a company. I think what the revenue are concerned about as well is something that they call artificial steps. So if you suddenly have a company that you incorporate into, the revenue are looking at that and saying, well, we think this is an artificial step. So what is the commercial reasoning behind this? So they are looking a lot more closely at effectively artificial situations arising. But certainly, I mean, there is a lot of positive things about having a business structure, having it as a limited company, being able to enter into joint ventures, being able to create a group relief. You can offset losses, you can transfer properties, you can grant leases, you can do all sorts of things within a company structure that you can't do in personal names. But it does come back down to the individual and what are your best intentions for the next sort of 5 to 6 years.
So let's talk about joint ventures, as you just mentioned it. It's always been something of probably a mystery to your everyday Mr. and Mrs. Smiths who are on the street. But an increasing number of our landlords, property investors are in the trades. Been very successful over the last 3 or 4 years because there's been so much money in the economy spent. As a specialist in incorporation and tax, where do you sit on joint ventures? Who's doing them and why?
Okay, so joint ventures are a fantastic tool. They are fantastic for people to effectively undertake a project, a development, a purchase even, where they don't necessarily have the funding for it. So they'll get together with an investor, and the investor will seed the investment, and they'll say, well, okay, that's great. You put in your 300,000 and leave the rest to us. So, I spend a reasonable amount of time drafting up joint venture agreements, which enable clients to have that flexibility, which provides for the way in which the project will be managed, the way that the profits will be split. And again, that those joint ventures, they can be owned, the shares in that joint venture, if that joint venture is a limited company, so 3 Acacia Street Limited, the shareholders can be your family investment company and the investor or the investor's company. So they work really, really well. Obviously, with any agreement, if it's 50-50, that always presents some problem, because you'll always, be concerned about a deadlock, and what's going to happen in those circumstances and how it's going to operate. And ultimately, trying to buy the other 40% or 50%, 60% out, it's never straightforward. But I think having a really decent joint venture agreement in place sets the tone for the way in which the development's going to happen. So obviously it's like really exciting, and you've got a prospect of, making a reasonable amount of money on a property that you've identified or somebody's found for you. Somebody's come along and said, yeah, well, I can put the money in. And, and obviously with any relationship, while it's working, it's fantastic. My job, obviously, is to try to accommodate when it doesn't work. But I think that they're a tremendously useful tool. They can get a bit overused, but I think all you need to think about it when you really boil it down, it's just an agreement between two parties, whether they are two limited companies, two individuals. It's just an agreement. This is what we're going to do, and this is how we're going to do it. And I think the more detail you can put in it up front, the more you can demonstrate your intention on how you think the development's going to go. I think the easier and the better it will be.
Yeah, it's an interesting one, because everyone, I think it's excitement and that kind of thing which draws people around, and the amount of things that drop across my desk that I look at and go, there's money in that, but it's at such a level that I don't have the ability to go and do anything about it, and then it just passes straight over. That's where those sorts of things give someone an option where they're in an advantageous position, whether it be an estate agent or a builder or someone who finds land or someone who owns land but can't do anything with it, rather than just purely selling it on, is actually being able to do it for themselves. But normally the excitement means everyone believes the world's rosy, and we're all going to get on, and we're all going to make loads of money, and we'll shake hands at the end, right? And I'd love to know the amount of times, especially, even just having builders extending your house. It never goes to the plan that someone gives you, does it? It always overruns. It always goes over budget. There's always something that you have to go back on, and having some sort of terms of agreement can only give you a framework to point at if that happens.
Yeah, and I just think as well that that they, another consideration that sometimes depends on the seller, but you could also we look at options. So that provides an element of security without you having to put all your eggs in one basket from day one and purchase it. And it will also give you time to see whether or not the planning that you think is going to be effective in this particular scenario is going to work, if there's going to be additional problems, if you're going to have to get additional surveys, or the costs in terms of what the site was previously used for. So options are another thing that I think work quite well. But I think that clients also have to understand that you're going to have to financially invest in this in order to see whether or not it's going to work.
Yeah.
And that comes back to the fees. You know, and you know, if somebody wants an option agreement, or if they want a joint venture agreement, or if they've decided to go together on a shareholders agreement, they're going to change the articles of association. You know, if you want to put those elements in place, then you're going to have to pay somebody to do it. And so it may be that you know, it's something that comes across your desk. You've got to be prepared to maybe invest 10, 12, 14,000 into seeing whether or not this project is a go.
Yeah.
If it is a go, it could make you £300,000. But if you're not, or you don't, you know, you don't want to invest that money, then it's going to expose you potentially down the line. And I think that's something that, you know, you almost need to, in your mind, set aside a budget for your research and development on whatever projects you're working on for that year. And you've got to be prepared to say, well, okay, I might spend 25,000 on this, but in the grand scheme of thing, over the course of the year, I've actually made 400,000 or whatever it is. I don't know. Maybe made 70,000, but you've offset your costs.
Yeah, you've got, if you put that money into something, it goes nowhere. You take it out of the one that it did go somewhere out of that profit. So for every one that you push the button on, there might be 2 or 3 that just never happen because of, like you say, the issues with development and planning and options and that kind of thing.
And if you're in a group, if you've got a group structure in place, so you've got your top company and your various joint ventures or other elements underneath, you know, if that particular joint venture does lose you 15,000, then you can offset it against profits in one of your other, joint ventures or somewhere, you know, within that group structure. But, you know, if you don't want to pay somebody to put a group structure in place, you can't offset it.
Same old story keeps rolling round again.
But it's
the truth in pretty much every walk of life, isn't it? You either roll the dice and take a massive gamble. If it comes off, great, all power to you, well done. You've beaten the system, and you might spend a few years looking over your shoulder, wondering whether someone's going to come back at you. Or you protect yourself and do it properly. It doesn't matter what line of work, what line of investing that is. It's the same across the board. You should always, there's hundreds of thousands of people who do their own tax returns because they won't spend 300 quid on an accountant doing a basic tax return. For all they know, they're not claiming one of the 1,200 allowances and reliefs that they could do, which would more than cover the cost of a tax return. It's certainly something I've learned since setting up my own business over the last 3 or 4 years, that sometimes it's easier just to pay an expert in their field rather than trying to build it yourself.
I mean, slightly negatively, but at least one of the advantages of paying an expert is that their advice is going to be covered by their professional indemnity insurance. You know, I mean, we carry 5 million per claim. So that's also what you're paying for. I mean, you're paying for the expertise and you're paying for a regulated professional. And, you know, if you get it wrong, which...
I'm not doing my own gas certificates on landlord properties. I'm going to let someone else sign that off. You know, that's how basic I see it. Is I could go out and get qualified to do gas certs and save myself 90 quid a shot on provisions. Why? Like, you're just putting yourself out there to be shot at and make mistakes when, as you say, you're covering, someone else can cover the liability. If the HMRC come after you, go, my accountant. And leave it at that. I mean...
But also you find that you can spend, your time is better spent doing the things that you excel at. So if you are fantastic, you know, identifying a bargain in terms of land, or you can see the potential in something, well, spend all of your time doing that, because that's where you're going to make your money. Yeah,
and speaking frankly, I never want to have a conversation with HMRC.
No.
None, ever. Zero. No. I don't really want my accountant to either. So, I don't want to come across that, because I know I'm going to get forensically searched if they find one thing. They go, oh, so you own this business and this business and this business. Open the books.
Yeah.
because, like you say,
Yeah.
there's that ripple effect of,
Yeah.
well, you've done one thing,
Yeah.
so there's a good chance we're going to find something else here, so you might as well spend some time.
Yeah.
So
Excellent. So I think we've covered everything that we wanted to cover, Amanda. So thank you again for coming in. Really appreciate you taking the time to come and see us today. There's some great stuff in that podcast, some stuff that I didn't know, some stuff that I'll take away and go and learn on now, especially the 1,200
We will be
tax
testing
benefits. Will be. If anyone can name them in the show notes, that'll be a good list. But no, thank you again.
One last plug for Amanda's podcast.
the Property Planet. Yes, thank you.
Good name.
Property Planet. Love it. But yeah, all the details will be in the show notes. Amanda, thank you again. And thank you for listening on the Investors Podcast, and see you next week.
Why have we made the Investors Corner podcast, Ian?
I think online at the moment there is just way too much noise, waffle and nonsense. Everyone's got an agenda. So the goal was to make a podcast for people that want to invest money in property or other areas where there's no waffle, there's no nonsense, there's no agenda. It's opinion led, but it's an honest opinion. And it might not be the right answer, but we're going to share it.
So on the podcast, we're going to supply people with access to mortgage brokers, financial advisors, planning experts, development consultants, everything around the property industry and the wider fields.
Yeah, so if you're looking at investing in the future, you know that just having an income from your employer or from your business is not enough to give you the life that you want down the line. We're going to hopefully give you some of those answers that will give you the solutions you need for the future.
So please hit the subscribe button. The more subscribers we get, better guests that we can get on, and the more people that we can reach. So hit subscribe.